right, guys, so have you ever heard somebody say that you can buy a house with no money down, you can buy this investment property and don't worry about having cash, you don't need any cash, and thought to yourself immediately, oh my gosh, this is probably the biggest hustle ever. Well, here's the thing. There are people doing this, and this is how seasoned investors actually buy properties. Now, here's the thing. Money does exchange hands, okay? There is money coming from a bank, and there is money coming from a private lender, okay? And you might say, well, I can't qualify, and I don't know any private lenders. Here's what I'm doing in today's video. I'm actually interviewing a very good friend of mine. She's a seasoned loan officer. She's been an underwriter for like 20 years, and that is the person inside of a mortgage company or a bank who actually looks at files and decides if the bank will lend this person money. And now she has taken on the role of a loan officer, and so what she's able to do for her investors is evaluate deals and evaluate files and then help them get money. And she explains kind of from start to finish at a very, very high level so a new person can understand it exactly how somebody would go about buying a property with no money. And you might say, again, hey, I don't have very good credit or I don't know anybody with money. I'm going to solve that problem for you in today's video as well. So stick around, I'm going to get into it. Okay, so before I get into all this stuff, the first thing I need to do is just a little CYA for me, okay? So the first thing I want you to understand is that any numbers that we talk about are going to be completely hypothetical. We are not extending any type of credit offer. This is not some sort of approval. Any rates or payments or those types of things are only to be used for educational purposes. This is not an extension of credit, and we are not giving actual rate quotes, okay? The other thing is that during this interview, we're going to talk about a very specific calculator that we use to establish the initial loan, which is going to be a hard money loan, and then the secondary loan, which is going to be a DSCR loan. And we have a spreadsheet that we use, and we punch in numbers, and it gives us a pass-fail. If you want access to that, it's going to be the second link in the description below if you're watching this on YouTube. And if you're listening to this on some sort of audio platform, you can go to the wholesalersblueprint.com/tools. And that's going to get you access to not only this calculator, but a bunch of other calculators and a bunch of scripts as well. It's going to get you to my investors toolbox. That's the wholesalersblueprint.com/tools with an S at the end of it. So, okay, with all that said, gonna dive in. Let's go, guys. Cool. So the first thing I want to do is I just want to welcome my guest on today's call, Jean Ayemin. Jean, I met her I think maybe 3 or 4 years ago. And here's a really kind of funny story. When I was first coming up in the mortgage business, I was building a team and I was bringing people on, and the owner of the company I was working for, he told me, he said, hey, we brought this person in and she has all this underwriting experience and she wants to come in as a loan officer and start originating loans and be, part of this team. And, you think you can work with her and get her kind of up to speed and teach her our processes here. And so it's really stinking funny because I'm sitting in my office one day and Jean walks in, and Jean's like, like 5 feet tall. She comes walking in there. She got this power walk, and she just says, give me leads and I'm going to call on them. And I'm going to make some deals, just like this really wonderful energy, and was ready to go, just like super fired up and ready to go. And the thing about this kind of meeting that we had is, when I first met her, her experience was like, at that point, like 1,000 times my experience. I was thinking, like, how in the world am I ever going to lead this person who knows so much more about lending than I do? And so when we originally started, half of the stuff I was just kind of guiding her on was really just, talking to people and just giving her leads. And what I learned really quickly with someone like Jean, this high performer, somebody who's at like the very top, is that when they're running and they're wanting to get into a business, the best thing you can do is just get out of the way. And that's how it's always been. I can't provide any value to somebody who is so much more talented than me. And the one thing that I've always really loved about working with Jean, I'm just kind of bragging on you a little bit here, Jean, is that Jean has always had like an amazing heart to serve, right? So it's no secret that on my channel, I talk a lot about this being a Christ-centered business for me. Jean fits and is a part of that. And one of the things that I always kind of remember about her when she originally started was her coming in and saying, look, I want to do loans for veterans because my husband was a veteran or is a veteran, and I want to help these people. And We had policies in the company that we worked with in terms of margin that we would work within. And Gene was always coming into the office, trying to get exceptions for the veterans to get them a really great rate at a really low price. And that's what I always thought was really awesome, is that her heart to serve is just, super, super massive. And so anyways, I know kind of a long introduction, but Gene, I would love for you to just kind of tell me, from your side of the coin, coming into like the lending side, outside of underwriting, what did that look like for you walking into my office?
I actually enjoyed meeting you, Johnny. I always thought you're very funny and you have a great heart, and you always let me do what I need to do. So I appreciate that. Coming in, I have always thought that I can contribute because I know with my experience, and I've been in the underwriting for 25 years, the last 12 as an underwriting manager, always in the corporate world. I'm done my share. I feel that it's time for me to go out with my experience to help the borrowers out there. And being that my husband was a Marine for 9 years, was in the Persian Gulf War, I have always have a soft spot for the veterans, and I always want to take care of the veterans. I actually want to help all the borrowers out there with my experience, to give them a really good rate, and to always be there available for them. And that's the reason why when I joined Johnny in the company, my business is all referral based. I would rather take a cut in anything that I could make, but the Lord has blessed me with more volume because of that, I think, because I'm high volume. I have a lot of people that will come to me for loans, and based on the referral. And I think that's because I'm always available for them. I'm always there for them, and I'm always trying to structure the best deal for them.
Yeah, and I think the thing that you're known for inside of like the lending community is really the person who can get the deal done when other people can't. Whenever we would get tough deals in, and we had 40 or so loan officers, and whenever there was a tough deal, or even if it was a deal that really wasn't that tough, but it was very specific, a lot of people don't understand how lending guidelines work. I think they have an idea, but the nuances between lending guidelines and also bank overlays can be really confusing for people. Like what one bank might accept, another bank might not accept, and finding kind of finding the right program in the right bank for a very difficult scenario. You've always been the go-to person for that. It's like, bring that to Jean. She can find a way to get it done. And if she can't, then it's a problem that really with the borrower. There's either an income situation or a credit score situation, but very few times has there been like, have you not been able to get a deal done? And that's why I think, Gene, you do so well with referrals, is because when you start working with agents and investors, they know that they have spoken with other LOs who have promised them things, and those LOs, they can't. It's not out of bad intention. A lot of times, a new loan officer will think, well, this person fits inside this box, and then they get into underwriting, and the underwriter's like, nope, that's not happening. And so that's where your value comes in as a person with 20 years of underwriting experience. You don't have to wait for another underwriter to look at it. You can tell right out of the gate, is this deal going to go? Does it qualify? Does it make sense? And so I think that's been kind of the from an outsider's perspective, the key to your success. And that's why when people are inside of some of these groups and they ask about loans, I'm always like, Gene is literally the GOAT of lending, because it's true. You literally are like the Michael Jordan of lending. So,
Thank you, Johnny. And it's funny you said that, because my first loans were all the 40 loans, the leads that you gave me, where nobody could do anything to help these borrowers. So out of the 40 leads you first gave me, I went through, I was able to help and actually help 10 of these borrowers, and we were able to get loans through for them. And to this day, I think 3 of those borrowers are still reaching out to me, talking to me just in general, and sometimes even giving me more deals. So yes, it's very gratifying to be able to be able to help borrowers that other people can't. And my specialty, I notice, is that challenging files where other people can't do, I am able to get through them. I think it's because of my background, the fact that I used to be an underwriter. And as an underwriting manager, most of the underwriters that could not do the loans have to come to me for second reviews, and I'll find ways to make the loan work. So anything that is a challenge for others, usually I could do it pretty good.
That's awesome. Well, what I want to do is I kind of want to just change gears a little bit and to kind of all of that, those points. I think that's one of the benefits that you bring to a lot of the investors who are now working with you and I on purchasing properties and doing rehabs and DSCR loans. So, my goal for this interview or this video or whatever is really to help educate the new investors on what is known out in the world as the BRRRR strategy, this buy, rehab, refinance, repeat strategy. And there's a lot of videos out there that talk about kind of the strategy and how the numbers work and all those good things. And it's a really very simple strategy when you talk about purchasing a property below market value, adding some value to it in the way of rehabbing, and then getting it, updating the kitchen and the bathroom by spending maybe $10,000, but adding $25,000 in ARV value. When you finish doing that rehab, you eventually have a property that's worth more than you have initially purchased it for. And that allows you to then go in at this higher value and draw all the money out, pay off any of your investor partners that helped you purchase the property, helped you rehab it. And then it allows you to have that property as a cash flowing property forever and ever. Amen. With most of the time with no money out of your pocket. Right. So I know there's a lot of videos out there that kind of go over those things, and I'll probably do one anyways, just to do a breakdown of the numbers. But what I want to talk about, what none of them is they don't ever talk about it from a lender's perspective. And this is really the most important part. And this is why you've done so well serving the clients that we bring our deals to, that buy the deals from us, that are using this BRRRR type of strategy, is because what you do as a lender from a lender's perspective is you can see all the numbers. And this is the most important part, right? So I want to talk about first, just the initial loan that you would buy, or the initial loan that you would use to acquire a property that is a rehab type loan. People get weird about the hard money loan. They don't understand it. Maybe you can give us an idea of why somebody would buy a property using a hard money loan.
Yeah, a hard money loan or a private money loan, they are about the same. Hard money usually are with a mortgage lender, and the private money is with a private investor. And hard money generally have higher interest rate than the regular conventional loan. And they are also generally higher than the private money and higher fees. But what the hard money and the private money people can do is that they can close the loan really fast in maybe 2 weeks. And also they are short term, like maybe 6 months, 12 months, sometimes maybe 18 or 24 months, but generally they like to keep it to just 12 months. And what you want to do is, like, if you got a property that needs a full rehab, you want to get the fix and flip loan, which is technically also a hard money deal. And you want to get that, right? For those investors who are not first-time investor, but who might have some experience under their belt doing the fix and flip, you can get up to 85% to 90%. What they do is, like, say, for example, if your loan amount to buy the property is $250, and they will do a 85% loan on that, and then they will loan 100% on the rehab. Let's say the rehab is 100,000, they will loan on 100,000. The combined amount make it to almost 91%. So you will only need to come in with the 10%, the closing costs, and you need to make sure that you have some reserves, right? And if it takes you 3 months to do after the loan close and you do the rehab and the ARV can actually go up to maybe 500,000. That gives you a lot of profit margin in there now, right? And after your loan is done, and the rehab is done, you at that time can access and see if you want to keep this property as a rental, if they cash flow nicely, or if you just want to sell this for a profit. If you want to keep it as a rental, then that's the time we will refinance you out of this hard money into a DSCR loan at a lower rate. But it will be based on your ARV, which is the higher loan amount. And sometimes the cash that you put in, not only will you get it all back, but sometimes you can even get more cash on top of that. And I actually have come up with a form that I can just plug in the number and show you all the number, the net profit, and what the cash flow could be.
So let me just get this straight. So the way a investor would come into the property is, let's say, and I'm going to use the number 100,000 because it's an easier number to calculate the percentages. So let's say I was purchasing a property that needed some rehab and my buy price was $100,000. The hard money lender would finance roughly how much on that 100,000? And just for lack of a better example,
85,000 if you are experienced. With a fix and flip. If you're not, depending on your FICO score, they can do 80%. So 80,000.
Okay, so let's say for a non-experienced person, let's just say it's 80%, so it's 80,000. So where are these investors? Where are they coming up with that, the $20,000 plus the closing costs? Where are most people getting that money from?
Most of them are getting it with a JV cash deal, transactional deal, that other people will loan the 20% for a percentage of it, or other will just loan it for maybe 2-3 months for a certain fixed fee for it.
I see. So if I'm a new guy and I go out and I find a property that needs to be rehabbed and I'm like, man, this is a good deal. All the numbers check out. I can buy it. I can rehab it. There's margin in there. There's equity in there and all that good stuff. If I wanted to buy that, I could come to you and say, Gene, can you give me a loan for 80% of this amount, or maybe 85? I know some go up to 90. It's just depending on a bunch of different variables, but right. you would be able to help me with that part. And then I could go to, let's say, like my brother or sister,
yes,
or just any type of private money lender who maybe he's got the difference, right? So if I got 80 grand from you or the hard money lender, I go and say like, hey, can I borrow $20,000? I need it for this project over here. This is what the numbers look like, and then I work the terms with that person, right? So I would say, look, I'm gonna borrow 20,000 to give you, your 20,000 plus 5,000 back in, 6 months or whatever I'm negotiating there. So that would be how I would acquire the property, right? So now I got it. But the problem is maybe I need to put in $50,000 in, I need to fix it. So, right, I need to bring the ARV up. So where would I get that money from?
Well, then you will put in as a fix and flip. So your loan amount will be 80,000, but the 50,000 for the rehab will be included 100% in the loan. So basically the 20% of the loan amount, 20,000 plus closing costs, is what the borrower, the investor will have to get a cash or JV partner, or maybe from someone who is willing to loan him that 22,000 for maybe a fixed 5,000. Yeah.
So then I can borrow the 50,000 from the same hard money lenders, what you're saying. So not only will they give me 80,000, but they'll actually give me the rehab money as well, correct?
Yes. 100% of the rehab money. Yes.
So in order for that lender to give me that 50,000, what do they need? What does the paperwork look like in this exact scenario? Let's pretend like I've got the 20 or 25,000 on standby for closing costs and the down payment portion that I'm responsible for.
In
reserve. So in this scenario, I might need what type of reserves? What would they be looking at?
They will be looking like about 6 months for the carrying term of the interest payment, as well as the 10% of the rehab. So 10% rehab is 5,000. and 6 months of the loan amount may be 130,000 in this instance, depending on the interest rate, but it's a simple interest only.
So if my payment, let's just say my payment on this loan was $1,000 a month, I would need $6,000 sitting on the side.
Yes.
Correct?
Plus 5,000 for the 10% of the rehab cost.
Plus 5,000 for the rehab. Okay, perfect. So that definitely makes sense. What does a hard money lender look at when they're evaluating whether or not they're lending the deal, other than maybe the purchase price or my FICO? Is there anything else that they're looking at that might make a deal not doable for a hard money lender?
They always look at the appraiser, right? They need to make sure the assets value will come in as what you are buying it for right now. If your purchase price is 100,000, the assets value has to be 100,000, and then and the ARV. So if the after improvement and all in that you put in is going to be about 150,000, the ARV has to be at least 150 and a lot more. I to see one where the ARV comes in lower than what the purchase price and rehab amount is. So most of the time they come in way more.
Okay, so you broke up a little bit there, so I just want to recap that. So they'll actually do an appraisal on the property, and there's two things that they're looking for, right? They're looking for the as is value, the way it sits today with the busted floors and the busted roof or whatever, yes, what it looks like today. But then they're also going to look at what is it going to be worth when you fix all those things? And what is that number? And those two numbers need to match in order for them to lend all of at that value, correct? Or that amount.
Yes.
Okay, so that's pretty. Oh, go ahead.
That's correct. No, that was what I was saying.
Okay, so now I go in and I come to you and you fund that. And let me ask this question. So in this scenario, how long does it usually take to get that type of transaction done?
About 14 days.
About 14
days, depending on how fast we have to be. Generally, 14 days will be easy to do, because usually the appraiser will take about 3 to 4 days. And contractor bid, you need to make sure you get that in. But if the contractor bid is going to be delayed, then the whole process delays, because to be able to order the appraiser, you need the contractor bid in.
Okay, so not only do you need an appraisal for this type of loan this way, I know that there are other hard money loans that you can do that don't require these types of things, but we're talking about specifically a fix and flip that will fund the majority. That's the biggest problem with a lot of guys. And it's not even that it's a problem. Like most investors, they don't want to come out of pocket, right? It's like, how little can I put into this? And so for this type of deal, you would actually need not only an appraisal with those two different numbers, but you actually need a contractor bid that tells you and supports all of that data, correct? Okay, so awesome. So let's say I go through this and I buy this property, and let's pretend like the ARV is 200,000. So I use hard money, I buy the property, I take out the loan, I fix it, I flip it, everything works out perfect, which we all know happens every time. Everything's always perfect. Welcome to real estate. Nothing's ever perfect. But let's say I go through it. Okay. And so now I'm into this project for 150,000, and I decide, and it's worth 200. And I decide, you know what? I don't want to sell this. Like, I don't want to sell it and make the 50,000. I am a buy and hold investor. Okay. But I owe my, my private money partner who brought the 25,000 to the table. I owe them that 25,000. I got to figure out how to get that money, in his hands. Okay. And so, but I want to keep the property as well. So in that scenario, what can I do? How do I, if I wanted to keep it and I wanted to pay off the private money lender, how could I do that?
You can do a DSCR loan, right? And you can generally you can go up to 80%, but you get the best rate, best cost at 75%, and it will be based on the ARV.
So let me ask this question. What happens if I own my current primary residence? Because maybe let's say I'm a W-2 employee. I work for, I don't know, in and out or something. And I own my primary residence, and my DTI is my debt to income ratio is like I can't put another house on my credit because the bank won't approve it because my income, it basically covers all my expenses. So I can't go get approved for like a conventional loan or an FHA loan or a VA loan. Like, why would I get approved for a DSCR loan? Another house? How could I do that?
Well, because the DSCR is a no ratio, basically. It's just using the rent from the property to cover the payment. If your rents cover all of the payment, and that includes, if it's a condo, the HOA dues, it includes that also. If your rent covers those payments, and the higher your rent amount to cover all the payments with excess left over, the better it is. And that means your DSCR is over 1%, then you get really very decent rate for a DSCR loan.
So what you're saying is that if my expense against the house is $1,000 a month, but I can rent it for also $1,000 a month, then that's a 1-to-1 ratio, right? I've got $1,000 in and $1,000 out. So then they don't care about my income, right? They're not even looking at my income. That's my understanding.
And
right.
High FICO really helps you too.
So they look at that ratio, and then they look at my FICO score.
Correct. And they also look, if let's say you're getting 30,000 cash from there, then they don't need cash. They don't even need a bank statement from you for reserves, because they can use the cash as reserves.
So generally speaking, they'll want in this scenario, what's that?
Nothing. Generally speaking, you don't need anything. No documentation except your photo ID, a good credit score, and rental lease.
And a rental lease. Do I have to do an appraisal on these types of deals?
Yes, they always do, because they will take the current appraised value after 3 months seasoning.
Okay. So in this scenario, let's say the property comes in and it appraises at, I thought it was going to appraise for 200, but it appraises for 225,000. You're telling me that in that scenario, I could take out roughly 80%. Although if I go up to 80%, if I go above the 75% threshold, that I start taking some significant adjustments to the interest rate, right? So
interest rate and fees, actually.
Interest rate and fees. So the goal would really be to stay under the 75%.
Yes, 75% or under will be the best. Yes.
So in this scenario, let's say the appraisal comes back in at 225, then I would be eligible to bring my loan amount up to 168,750. That's 75% of the appraised value. So if my expense within this property is 150,000, I can now do this refinance, assuming it cash flows and all the boxes are checked. I can pull almost 170 out. I can pay off my investor who I borrowed 25,000 from, and now I have a property that's cash flowing for me. I have 25% equity in that property, so I'm sitting in an equity, a favorable position, and it's cash flowing for me every single month. So I have a tenant in there who's making the payment every single month.
Right. And not only that, you don't even have a single cent out of your pocket. And in fact, you already withdrew some cash out of the property.
Some of that above money, right? So if I'm into it for 150 and I take out 168, I've now put in, almost 20,000 into my pocket at that time.
Yes.
So do you see a lot of investors doing these type of transactions, Jean?
Yeah. I currently am doing 2 others. So yes, I am definitely seeing a lot of these. And that is the perfect way, especially if the property cash flow after you cash out with the DSCR loans. Why not? You're making rental income every month, and your property that you currently own is now totally done up, and you own it free and clear. I mean, in the sense that you didn't even have to come out with any single cents to get it.
That's awesome. And one of the things I just kind of want to point out, because I think one of the biggest like balancing acts that I've noticed, and I know that there are some DSCR lenders that will allow you to do cash out refinances at 3 months. So let me back up a little bit. When you do a DSCR loan, you'll need to be on the title for 6 months prior to taking cash out, correct?
Correct.
So the
Also
balancing,
can, but we do have some other lenders that will allow 3 months.
they'll allow 3 months.
Yeah.
That's good to know. And that's good to know for a lot of guys who are doing these, because what ends up happening is they will make a deal with their hard money or their private money lender, the first loan they're doing, the rehab loan, and they'll do a 6-month term. And so if they can't refinance and cash out at month number 6, it puts them in a weird bind because their loan is due on the first and they're not yet eligible for the second portion of the transaction. So my question for you is kind of circling back to the hard money loan. And you mentioned sometimes they'll do a 12-month term or a 6-month term. Let's pretend like I do a 6-month term and I underestimate my my rehab time. I go into 7 months. What usually happens at month number 6? If I'm like, look, the property is not done, I can't do the DSCR loan and pull the cash. The equity will be there, but my contractor took a little bit long. What happens with the hard money lender? Do they foreclose on the property, or what happens?
No. You all you have to do is reach out to the hard money deal, and what they do is they basically reset your terms, but they generally charge you a fee and their points. They always like their points, right? And then they might extend it for another 3 months or 6 months for a fee.
So what are the fees usually around the hard money loan? If somebody wants that first loan, what does that usually cost?
They usually are 2-3 points sometimes. It just really depends on the transaction. They are very specific to the transaction.
Okay.
The higher FICO score you have, the more cash reserve you have, the less the point. I noticed that. The lower your FICO score and the less reserves you have, then to protect them, they charge a higher fees and a higher rate.
So because it's a higher risk loan, because of some of those things, they take what we call in the industry adjustments to the rate, meaning it's just a higher rate at maybe a higher cost.
Totally.
So how can a new investor, how can they prepare themselves? So let's say today's day one and I'm just starting to get in the business and I'm looking for rehab, properties to rehab. How can they prepare themselves for this type of transaction? What can they do? What can they do to get themselves prepared?
Well, they need to start looking for, cash and transactional lender, right? Because that will be very helpful. Getting properties is, knowing the right contact. You have a lot of people out there that are always doing the wholesaling or creative financing. So that's not so hard, but getting the cash lender and the maybe even the gated lender or the transactional lender, those are good contact to have right now, because then your down payment is taken care of.
And then also I would imagine having maybe like a contractor on standby. So if you were to, let's say, put a property under contract and you need the loan, you need an appraisal, you also need a contractor bid. Like you would want to have a contractor who can come in, work up that bid really quick for you. So that way you could close quickly and also know that you know what it's going to actually cost.
Right. Because without the contractor bid, you delay the whole process. With the contractor bid, then the lender will be able to reach out and order the appraiser, because the appraiser wants to give you the as-is value as well as the after-improved value, which is the ARV. And they can't do that unless they have the bid. And it has to be a line item bid with details of what's been done, so that they know exactly which kind of comps they have to bring in to be able to give you the value.
Okay, that makes sense. And then on the DSCR side, is there anything that you see that maybe holds up transactions that you run into that are maybe not expected, or maybe like a first time investor might run into for the DSCR side of loans?
Most of the time I see is that they cannot verify their rent. Like, for example, if you are Airbnb and you're going through a management company, or if you're doing the Airbnb yourself and you can't print a statement, for the lender to do the DSCR, they need a statement from Airbnb to make sure that they can verify or average your Airbnb rent for the year, to be able to use it for your DSCR loans, to calculate the ratios.
And it's my understanding that, let's say I was going to turn it into like a long-term rental. It's my understanding that when you do that appraisal inspection, on the DSCR side, once the property has been rehabbed, you can either do some sort of rent schedule, like a 1007, or if you have a lease in place, that would also constitute kind of approval in terms of the amount that comes in.
The DSCR loan must always have a rent survey. So the lenders will take either the market rent or the actual rent. If the market rent comes in higher, they will take the actual rent. If the actual rent is higher than the market rent, some lenders are very aggressive. They will allow that if you can verify that the last 2 months, that's what you've been getting. Let's say the market rent on the appraiser was $4,500, but you've been getting $4,800, and you could provide me canceled checks or bank statement to show that you got it from the tenant for $4,800. They will use the $4,800 to your benefit.
Okay, awesome. So generally speaking, they'll use the lower of the two unless you can prove it's the higher of the two, or
Correct.
just basically the deposits.
Yes.
Well, that's awesome. Well, this is, I think, has been really helpful. And I think we wanted to keep this kind of tight. So my question would be, if anybody has any questions on how they can get approved for either a hard money loan or a DSCR loan, what is the best way to get a hold of Eugene?
The best way is to actually text me or call me and on my cell phone, 941-331-5554. I think that will be the best way to reach out to me.
Okay, awesome. And I'll put that information on the screen and also down below in the description of the video so people can have access to it. So this has been really fun, Gene. I really appreciate your time. I want to honor it. But I definitely appreciate you coming in here. I know the people who are watching this, you are just providing tremendous value. And the reason I know that is because I've spent so much time on YouTube watching other people's stuff. There's nothing out there like this that's educating the investors to this level, especially at the level of knowledge that you bring in. So I just want to just tell you how much I appreciate you and appreciate your time. And thank you for joining me on this.
Thank you, Johnny, for thinking of me, and I appreciate being asked to come here.
So hopefully you guys found some value to that. One of the things that got a little sideways at the end there was just how you can get a hold of Gene. Remember that every scenario is going to be different. So you definitely want to make sure you're talking to a lender that can underwrite the deal and give you answers on deals that you might be doing. So the best way to get a hold of her is going to be through email. It's going to be Jean@Merlion Mortgage. That's JEAN@MERLION mortgage.com. That goes directly to her. I'm also going to put that information in the description below if you're watching this on YouTube. And if you have any questions, because for sure we didn't cover anything, and I'm sure we left some stuff out, throw those in the comment section below. I answer every single question on every one of my videos. So again, I hope you guys found some value. Don't forget to like, subscribe. Thank you guys. Stay blessed.